The Federal Reserve is again poised to raise interest rates in an attempt to slow down the highest inflation we've seen in 40 years. And all the trickle-down effects can set up other things. But really, this is turning into an episode of Mythbusters because the president of Heritage Capital, Paul Schatz, is joining us now. And Paul, you say a lot of people are very misinformed about who controls what, where the tail is wagging the dog, and what the Fed can and can't do. I think.
That's right. So,
because I know nothing too.
So the Federal Reserve only controls one interest rate. It's called the Fed funds rate, which is the rate that banks lend to each other for one night. That's it.
Yeah.
People think the Fed controls all the interest rates out on the interest rate curve. That's just not true. So when the Fed raises or lowers rates, that immediately impacts the prime lending rate, which is what so many loans are based on. But the Fed itself just controls one single interest rate.
Okay. I hate to sound snotty. Why do we care then?
So we care. So first of all, we care, one, the actual markets, the bond market, the fixed income market, the market moves before the Fed does. So people think the Fed controls. No, the market moves, the Fed follows the market. Mm-hmm. So if the average person is saying, I want to know what the Fed's going to do tomorrow in the next meeting, there's a bond called the 2-year Treasury note. It's simply, you give your money to the government for 2 years. It's guaranteed by the government. That interest rate, the 2-year note, is what the Fed most closely follows.
Okay.
So if you want to see where rates are going, simply watch a 2-year note. Don't have to listen to Fed speak or all those confusing comments and commentary and questions.
Well, is it following it by design or just incidentally because they're both being shaped by the same factors?
The latter, incidentally. I mean, because the Fed is so transparent right now, the markets can sniff things out, sometimes wrongly, days, weeks, months, and sometimes years in advance. So you'll see where the market has already taken the Fed long before we have a Fed meeting.
Okay. In the past, you were very critical of the Fed. You said they did not raise interest rates, I believe, quickly enough.
That's right.
And now we're seeing the after effects of that. How do you reconcile those two things? Because now you're saying the Fed is being reactionary.
Right. And the problem is, in August of 2020, when the commodities, oil and all the foods we eat, when that inflation just started to percolate, I said, look, the crisis is over. The Fed needs to start taking very slow and gradual steps. No panic, like a long glide path. You're taking off from JFK, if you will.
Sure.
And the Fed didn't do it in 2020, and they waited till the end of 2021 to wake up. These are supposed to be the smartest, most brilliant bankers and academics on earth. They missed the crisis in 2008. And now here we are again. Mm-hmm. They were asleep on this notion that inflation was going to be fleeting and quick and don't worry about it. Well, they gambled with consumers' futures.
Yeah.
I mean, go to the pump.
Okay, so now we've got maybe a 3/4 of a point raise, which is, about 3 times higher than what it normally is, what you were advocating for. Where do we go from here? Now you're just putting the past in the past.
Right.
What's going to happen now in the next 6 months of the year? And what can we do to sort of ameliorate the effects of what could be a recession?
So for sure, the Fed's going to raise rates today. 0.5% is the most likely, although I'll say this. This Fed normally tells you long before what they're going to do. Because of how hot the inflation number was at the end of last week, there's a chance maybe 1/3 to 40%, the Fed raises rates by 0.75% today.
Okay.
Whatever they do today, in 6 weeks, they're going to do it again.
Okay. And what is that going to mean long term for all of us?
So what does it mean? It means that your credit card rates are going up. Yep. If you've got a home equity line of credit, that's going up. Anything, auto loan rates are going up. Anything that's short-term in nature is going up. And they're doing this, frankly. They were asleep at the switch, inflation. Inflation is now running. It was a little lower yesterday, thankfully, but it's still running at, really almost record highs. So the Fed is trying to stamp out inflation. Right. It worked for Paul Volcker in the early 80s.
Okay.
This Fed is not vigilant enough.
Okay. But we're still looking at, do you think it's going to work, this short-term pain for long-term health?
In all likelihood, yes, although there's going to be economic pain associated with it. The Fed is going to try to suck all the money that they put trillions out in the markets, tens of trillions really over time. But then the government put out another $3 trillion in 2021. So all that money has to get sucked out of the system for inflation to begin to roll over. We need people, when people can no longer afford to hop on planes and buy luxury goods, that's when we'll see inflation roll over. The biggest input in inflation, it's not food and energy, although we feel it in our pockets. It's awful to go to the pump and to go to the store, but housing and rent.
People aren't happy with that these days either.
New home sales are down 4 months in a row. It'll be 5 months in a row. It's just starting to get better. This one's going to take a long time. No quick fix.
No, I'm sorry. We wish we had better news for you, but better you get the truth from the experts, right? Thank you so much, Paul.
Thanks, my friend. Good seeing you.
Paul Schatz from Heritage Capital LLC.